Hey guys, welcome. We have a new episode for you guys. We want to go over, you guys asked us to come back and do these more often. And I agree. Sam and I want to be here and do these as much as possible because, man, there's so much going out in the gold market right now. And precious metals and commodities are going crazy. Gold has continued to hit new all-time highs. Commodities keep looking constructive under the surface. Coffee's hitting new all-time highs. Cocoa made a huge run last year. So as we continue to see these things move, we want to show you guys what we're looking at, what we're thinking about, and ways to think about this. And you can check us out at the Gold Rush for All Star Charts. If you guys go over there, you can see all of our information, all the things we do, and the way we do it. So, how are you doing today, Sam?
I'm doing good, Jason. It's good to be with you. It's a freezing cold day here in Kansas. I'm looking at 5 degrees here on my monitor. The ground's covered in snow, but I'm excited to talk about commodities and the implications of a weaker dollar. There's a lot going on right now.
Yes, and the weaker dollar environment is really what we're kind of focusing on here today. Just understanding how would we trade a weak dollar environment? You guys have seen some. If you've been trading for the last 10 years, you've seen a couple here and there. 2017 was a weaker dollar environment. 2021 was absolutely late 2020, basically after the election, all the way through 2020 or 2021 was a weak dollar environment. And you saw, some of these commodities make huge moves around 2021. So now going forward, how do we see that? How do we look at that? And how do we trade it most importantly? So let's get going.
For sure. Nothing we discuss today should be construed as investment advice, nor are we recommending you buy or sell any securities. For more on our disclaimer, you can go to allstarcharts.com/terms. It's all one trade, Jason.
So I had to start out with this one because it's something that I keep saying over and over again. It probably sounds ridiculous to some people because they're like, "Wait a minute, you guys see if you're one of my subscribers, you can see the portfolio. See the portfolio, you see all these different trades, you see two different portfolios. Why wouldn't we just dump it all into one trade? Hey, gold looks really good. Why don't we just put it all there?" And the reason is one, nobody knows exactly what's going to go up the most, and two, diversification is key. Understanding how to hedge yourself, how to make those big profits in a safe way is exactly what we like to do here. But also, just looking at the macro landscape, we're talking about China, we're talking about gold, copper, the commodities in general, international stocks. It's all one trade.
That's absolutely right, Jason. And here is what you're talking about. It's all one trade, whether you're talking about Chinese tech stocks or German industrials or corn and soybeans. They're all going to dance together. These are all very pro-cyclical trades. And if you think you can diversify by purchasing Chinese tech stocks and a basket of German industrials, you're crazy. They're all going to dance together.
Yes, that's a great point because when you look at all of these, what do they have in common? And people would go, well, it's, this or it's that or it's because of this. Really, it's when the dollar goes down, this is when we see these things start to really move. We haven't seen, like I said before, we haven't seen a down dollar environment for about 20 years. If you guys go to All Star Charts, you can see a recent post where I posted in our currency report talking about this. And the fact that when we're looking at copper, when we're looking at the commodities, when we're looking at these currencies that we're looking at buying against the dollar, it's all one trade. So look at all these countries. They don't all have a bunch of things in common, but they do tend to move in down dollar environments. And in 2000 to 2008, we saw that down dollar environment. Gold continued to move higher for that entire decade, basically made one of its biggest runs in history from 2000 all the way to 2011. Oil made one of its biggest runs, actually having a compounding growth rate of 30% per year during that time and making about a 1000% return during that time. So, I mean, there's huge trades here, but also at the same time, the S&P 500 didn't even cross 1%. It didn't give you a 1% gain during that entire time frame. So things you have to think about here is how will I play this? How do I make money in it? And start looking outside the United States. Things are going to get a little bit harder for the normal investor. It was easy to put money in the S&P 500 or the Qs. I've done it as well for the last 10 years. It was a great place to be. Now we kind of have to look at some different areas. And so this is just kind of a list of these different areas that we're looking at, and they're all starting to move, starting to get into some new uptrends. And Latin America, that's the bottom chart on your right. If you're looking at Latin America, that thing actually had a 600% return when the S&P had a one, not even a 1% return. So Latin America, these are things in Central America to South America. These things really started to move. So Brazil, we're looking at all the Colombia, and we're looking at all these areas because in this environment, that's where we want to be.
For sure, Jason. And you've talked about the bond market and the tail that wags the dog. If you want to talk about that analogy and how it relates to tech stocks, investors over the last decade have become accustomed to just dollar cost averaging into the NASDAQ 100, and it's worked great. And you've crushed a lot of your benchmarks if you've done that. But that's probably not going to work going forward. A lot of these international investors have become accustomed to just putting money into India, and India doesn't look like a great opportunity right now. You're seeing rotation into China, you're seeing that rotation into Colombia. A lot of these countries, nobody's cared about at all over the last decade.
Yes, and when you look at it, there's a lot of things, and people look at these countries and you look inside the ETF and they go, oh, well, it's mainly financials. Yes, there's a lot of financials in these countries, but what do they invest in? And these are a lot of commodity-rich countries, so we see a lot of investment in the commodities area when we're talking about South America. Tech stocks, part of the reason that we're seeing them possibly topping out is if we're looking at valuations. If you're looking at valuations, this is most of the time, and you guys have all seen those charts. People share them every single day going, valuations are up here, the market's going to crash tomorrow. I'm not here to tell you that. I still think that tech could still go higher. I'm not saying it's a terrible investment by any means. But what I am saying is that when valuations get that high in technology and we see yields all the way up here, they start to put pressure on the price to earnings ratio. People start to find other areas they want to invest in. And to me, one of those areas is international stocks. Another one is commodities. And people have been beating the China thing to death here. But there's other areas inside of the international stocks that I want to talk about today as well. Brazil being one of them. I really do like the idea of looking at Brazil. It's a very commodity rich country. If you're looking at agricultural stocks, also looking at just Latin America as a whole, if we're looking at a down dollar environment, that's probably the place that's going to outperform. Also, Poland. A lot of people don't like to talk about Poland much. We talk about the Zloty from time to time just as a joke. But man, there's some great investments there. That stock market has been a major performer this year, outperforming almost everything. I think it's up 25% year to date already. So
For
once
sure.
again, it's outperforming everything. So Colombia is outperforming most of the countries. I think it's up almost 20%. Poland's up almost 25%. What this is saying is it might be time to start looking outside of the United States.
And also on the valuation note, it's just better risk reward. Like in the United States, you can get a quality tech stock for like 30 times earnings. But then you go to China and you can buy these like Pinduoduos and Alibabas and some of the greatest tech stocks in the world for single digit earnings multiples. It's just better risk reward.
Yes, and I see somebody said shout out Slotty. Please feel free to write in questions, anything you guys want to see. We love to hear from you guys. But yeah, there's so much out there that we need to continue to keep our eyes open. So let's look at the next chart, Sam. So looking at the dollar here, and you guys saw this last week, and you're going to see this probably every single time I go live to talk about anything, because the dollar is always the most important thing that
This
I'm
is
always
front and
looking at.
center.
Yes, it's the first thing I look at if I'm doing any form of analysis. I want to see what the dollar is doing. And part of the reason here is to show you guys. So if you go back, and this is part of the valuations, the idea of where we want to start investing in. So if you see a situation where you go, okay, well, the dollar is moving higher, and money's flowing into the United States. Most of the time, that's going to go into the biggest sectors in the United States. That is the technology stocks, and we've seen that environment. And if you've been trading for about 15 years, That's the environment you've mainly been seeing. Basically, since the bottom in March 2009, the dollar started to move higher, technology started to lead the way, and you've been the smartest guy in the room just buying the technology stocks. But people act like that's always been the case. And that's just not true. So, go back to 2000, the end of the dot-com bubble. We saw tech valuations at higher or just a little bit lower than the levels we were seeing today actually. So tech valuations were very high, but the companies were nowhere near as big or as great as they are today. So it's a little bit different in that case. But we saw these valuations hitting up there, and then money started to rotate out of the technology stocks and back into things like international stocks, microcap stocks, but most importantly, gold really led the way. So gold was the one that really kind of was the safe haven early on that you could put your money in. It continued to make money. When the market was going down, it was going up. It was the place to be. Now, today, we're kind of seeing that same area. Whatever the environment has been, gold has been holding up very well. Whether tech stocks are going up, energy stocks are going up, whatever it is, gold has held up really well. I think this environment's looking more like a 2000 environment where we start to head into that down dollar environment. Money starts flowing into international stocks, Chinese stocks. Obviously, we're all talking about China like crazy over here, but also the commodities. That's the thing that people aren't talking about enough right now. The commodities complex is the place where you actually will make a ton of money as a trader. And yes, you can look at these commodities and then find the underlying equities inside of them. So, for example, if you're looking at copper, you could look at copper miners. You're looking at oil, you could obviously look at energy stocks. Whatever it is, you can kind of find a place to be. Gold, obviously, the gold miners, which we talk about here at the Gold Rush all the time. So, once again, this is a great time to start looking at these other areas and paying attention to them. Nobody knows the future, but it usually looks a little bit like the past. And this is looking very similar to that 2000 situation I keep talking about.
For sure. And it's not just metals that benefit, it's the entire commodities complex. And a lot of these times when you're investing in a different country, you're not necessarily betting on the companies in that country, but you're making more of a currency bet, right?
Yes. Yes. And that's perfect because I think when people hear you talk about like, China or Brazil and they go, "Oh, well, it must be something to do with you love Chinese stocks or something." And it's like, "No, I just want to be in the things that are going to outperform and make money." That's got to be your goal as a trader, however you need to position yourself. And most of the time, when you're looking at these currencies and you're starting to see these currencies showing relative strength, like the zloty is one that has been showing relative strength for a while. Um, and then also you start to look at Europe and you start to see, okay, well, the dollar's kind of topping out here. And now Europe's actually making new highs and big moves. And the financial index inside of Europe is making new all-time highs. So if you just continue to look at that, you go, okay, well, this is a currency play. But also that means that other areas should start to move as well. So let's hop to the next one.
For sure. And we have someone in the chat asking about our favorite metals setup right now.
Oh, it's in
We're gonna
here.
get to it.
I saw that. Yeah, we'll get to it. Yeah,
Yeah.
great question. But we'll get to that one because that's in here. And feel free to ask questions, guys.
For sure. Gold has been the place to be for quite some time now. Gold broke out of a massive base back on March 4th, 2024, and it's pretty much just gone up in a straight line since then. But is this where we want to be right now, Jason? Is this the best risk to reward setup in all of commodities or all of metals? Let's be more specific.
So I don't think so. And Sam laid this out the other day, and we can't give away too much. So if you guys go to Gold Rush, you can see a little bit more of what we do. But the one thing that we're thinking right now is that gold might start slowing down. I think, neither one of us are exactly bearish on gold by any means, but thinking that it could slow down makes some sense here. It just breaking, making new all-time highs day after day. That doesn't last forever. But what we usually see in the commodity cycle is gold starts to make a new high, and then the commodities start to follow it at some point, and at some point, those commodities start to massively outperform those. So, metals wise, we're starting to see other areas that are starting to look really good.
For sure. Silver is probably the one you've been most vocal about in recent months. But that's for a good reason. You know, silver can really move. Look at this measured move from back in 2020. It rallied about 150% in a matter of 4 months. That is that's crazy.
It's a banger of a move,
Yeah,
and that's the reason why I highlighted that move was that a lot of people forget how quickly silver moves when it moves. A lot of people have been thinking about the way silver's been since then. The sideways, choppy mess, hard to trade, frustrating. But then when you really look at it and you go, oh, silver made a 154% move in basically under 5 months. I mean, that's how silver really moves. So I'm not saying I think it's going to make a 100% move in 5 months again, but I do think that it's going to make a big move soon. That situation was COVID. We had, a lot of panic selling into a false bottom, basically, because just people needed money for margin at that time. So that's usually what you see during panic sells. But either way, if you go back even further, there's plenty of periods of times where there's not panic selling, and then you'll see silver make a 100% rally. So I do think silver here could absolutely hit something like $50 pretty quickly by the end of the year. That's nothing that I think is impossible. I think a lot of people keep writing those moves off, but I think those moves could absolutely happen.
for sure. And it's not just silver in the precious metals complex, but it's also platinum and palladium. Don't forget about those. Those have been kind of ignored. But I think that is at investors' own peril. You know, those setups are extremely ripe. We're talking about them all the time at Gold Rush. We've talked about the volatility squeezes there and platinum, palladium as well, but man, those are going to move, and it's going to move more than silver. 150% in a few months in silver can be 300% in a few months in platinum and palladium.
Yes.
But this chart here is gold overlaid with silver, and I think this just speaks to gold ringing the dinner bell. Is that right?
Yes, and these are the moves that we're talking about. And this is part of the reason JC was going to get on the call with us today. And, he just said, gold's more important than me. You guys go talk about it. So he kind of just let us go. And I think that that's important because that's the truth. Gold, silver, these things are more important than just about these moves that we're talking about today are more important than just about any of us. Because when these moves happen, they really take off. Now, once again, some people just go, okay, silver's been lagging for a while. I guess it'll continue to lag forever. That's just not how markets work. It's not how anything works, especially silver. Look at the relationship. Yes, people can say the relationships change because of this, that, or the other thing, but in reality, the relationship hasn't changed because people are the same. And psychologically, when gold is moving, and they go, okay, gold looks really good, but man, it's getting pretty high up here, which I think any of us can see. They're going to go, well, maybe I should start buying silver. Maybe I should start buying the gold miners. Maybe I should start buying these other areas. Silver being probably my pick for as the question came up earlier, for my favorite metal setup, but also looking at the silver miners inside of there. We can't exactly give away the exact trades that we're taking, but we're talking about junior miners and silver miners quite a bit at the gold rush at the moment, and there's some moves that are happening. So continue to watch these areas for outperformance, and that's where you're going to want to be going forward to make those big returns. I love a lot of trades right now in the silver space. So continue to look at silver, continue to watch those breakouts. I think silver, we're going to look back in a few months and go, wow, that chart of silver looks very similar to gold.
And how we were talking about earlier, like none of these markets operate in a vacuum. If we see risk appetite increase in the precious metals complex, that means silver's participating, that means platinum is participating, and palladium. But not just that, it's also these more speculative miners, oftentimes from Canada. But these miners can move like nothing else, really. They can go 10x in a matter of a year. That's what we're talking about here. This is some serious moves.
Yes.
And here we have gold futures in the upper pane, along with 2 year versus 10-year yields in the lower pane. And this just speaks to the relationship that credit spreads have to gold.
Yes, and you guys have seen the chart of the CRB index and the yield curve, which everybody loves. I really like that chart as well. But this one's how the party gets started. So what we're seeing here is that every time we get into an inversion and money gets tight, people get a little fearful in the world, we start to see gold start its move. It happened in 2000. It happened once again in 2006, 2007. As everybody knows, yes, gold made a really big move. I think it was 200% before the great financial crisis, but after the great financial crisis, that's when that thing really took off. So basically, making a huge move, that's when it almost hit $2,000. And then it consolidated for a long time. As you see during the consolidation, the yield curve starts moving the other direction, and now money supply is tightening. This is the way you look at it. If it's moving up, the money supply is loosening. If it's going down, the money supply is tightening. So then we finally get to another quick inversion that was in 2019. That was August 2019, and that's when gold started this new major rally that we're still into to this day. Went sideways for a while as the money supply tightened up again, and then once we get into inversion once again, what happens? We come out of inversion and then gold starts to move even higher. So, that's one way you can kind of take this home with you, make your own analysis from this. And that's kind of a good teaching moment. So you guys can figure out how you're going to trade these markets and how would you make money from this scenario. Somebody also said wheat and precious metals just hit another all-time high today. Like that's the things we're talking about. That's mainly a silver stock. We're seeing all these things kind of happen over and over and over again. So continue to look at the precious metal sector because that's something that, Sam and I cover every day, but also it's an area that protects your wealth. If you're just buying stocks, you're missing out on a big part of the market. Commodities and commodity-based stocks, they make big moves as well, sometimes much bigger than the other stocks.
Absolutely. And we were talking about a weaker dollar environment earlier. So, how do you think about weaker dollars and the yield curve? Which one means more to you?
So this is a great question, Sam. So if we're looking at the yield curve and gold, to gold, the yield curve is the most important. But if we're looking at it in the position of dollars and the yield curve, so if we get when we get both of these moving, that's when the party really gets started. That's the thing that we're missing right now to get this thing taking off like crazy. That's the thing we're about to see. Look at if you look at the 2 year yield compared to the Fed funds rate, now it's back to its normal relationship where the Fed funds rate is above the 2 year yield. That hasn't happened in a long time. So now we're kind of getting to this point where the money supply is loosening up and also the dollar is topping out. This is the reason why we're starting to do these lives right now about this, because this is a period of time where we usually see these massive moves start to happen in the commodities market. So once again, continue to pay attention to these things, and we will be probably rewarded with these moves because these moves are going to flow into the commodity space. And right now, gold has already moved. Now it's ready for silver to start to move, and then the rest of the commodities will follow.
For sure. And this is a very similar chart to what we were just looking at with the yield curve, but it also includes the entire treasury yield complex, I guess, if you will. So you have pretty much every treasury in the upper pane here. You have the 30-year, the 10-year, the 5 year, the 2 year, the 3 month, and then you have the federal funds rate. And then in the middle here, you have the 3 month versus the 10-year yield. This is the yield curve. This is what we were just looking at, overlaid with gold. Gold bugs want to see this line going up. And then in the bottom here, you have the CRB commodities index. And this is a lot of crude oil, but it does encompass the entire commodities complex.
Yes, and that's the thing that so we were talking about it earlier, gold ringing the dinner bell. So during that inversion, what happens? Gold starts to move. But then after that, that's when the commodities complex as a whole starts to move. So now that we're coming out of that inversion, not just in inversion and moving the right direction, now we're coming out of the inversion. That's when the rest of the commodities complex moves. Look right back to 2020. Once we get out of inversion, we start to see that oil, copper, all of these things start to really follow it. And then it makes a crazy high. That was a blow off top that happened in 2022 during the Russia Ukraine crisis. And then the yield curve moved the other direction. And as they started to see inflation getting out of control, the Fed's raising rates, money supply tightens up. And then next thing you know, oil's moving the other direction, back down again. So now we're back into that. We went into the box. Now we're out of it, getting out of inversion up and over that zero line that you see on that middle chart. And now oil, the commodities are starting to follow it. So I really do think this is a good template to work off of here. Somebody said the other day, they were like, oh, it looks like 2008. I'm like, that's what you want to see. Most of the time, it doesn't. One, if you look at it, actually, oil made a huge move right before the 2008 event happened. And, if we were in a recessionary environment where I said, hey, the money supply is tightening, hey, there's all these things happening that's telling me that we're in a recessionary style environment, I would say, yeah, it looks like 2008. But stocks continue to move up. The bank stocks are the outperformers. Global stocks are moving. This isn't a recessionary environment. This is an environment where commodities can really catch a bid. So because of that, I would continue to stay bullish on things like the CRB index and look at what's inside of it and figure out how to position yourself to make money.
For sure. And if you look at something like the European Financials Index, the EUFN, that has resolved a massive multi-decade basing pattern, breaking out to new highs. That is not something you see in a bear market or a recessionary environment. These European financials are such a great barometer for market health and risk appetite because these companies suck. They are some of the worst companies in the world. So, um,
And shout
it's
out to the chart report. Thanks for putting my
yeah,
chart up there
chart of the day.
yesterday. So chart report, you guys got to follow the chart report. Great brand. Patrick runs a great thing over there. And my page is Jason P 138. If you guys want to take a look at that, you can find that index that we're talking about, and it just hit a new high. Or go on the chart report and see it there. But the main point is the index is hitting a new high. I don't want to be bearish stocks, but I also don't want to be bearish commodities. I might be a little bit timid on tech stocks, but that doesn't mean I'm bearish on tech stocks. I just want to be in what's outperforming because if I'm trying to be in the thing that's just going to do what the S&P 500 is going to do, I should just stuff my money in an IRA and walk away. As a trader, we're looking for outperformance, so we got to find the outperformers.
I think that's exactly right. It just all comes down to risk versus reward. Maybe these tech stocks can go up for longer, but
Did we lose Sam? Oh, we lost Sam. Okay. But yeah, so let's hop to the next one. Um, Sam, if you can hear, can we hop to the next one? So, anyways, we'll just go through this because to me, this is kind of what we're really looking at here. And when Sam gets back, Gene, somebody let me know. But what we're looking at here on this chart is incredibly important. And there's so many things to think about if we're looking at the CRB index. If we're looking at the CRB index, you're also going to see countries like Saudi Arabia should move. We should also see the financials moving. Think of 2021. 2021 was a period of time where we saw all of these things moving and tech stocks were underperforming. Now, if you look at a chart of the NASDAQ, you see the NASDAQ continues to move higher. Everything's just fine with the NASDAQ. But if you really looked at it or talked to other fund managers like myself, they had major troubles trading in 2021. And the reason was is that the S&P 500 continued to be the underperformer because tech was weighing on it so badly So where was the outperformance that year? Well, it was in some of these international areas. It was also in small caps. A lot of people don't talk about that. So we got small caps. We also have the financials were moving like crazy and energy stocks. Now, a thing that a lot of people don't know is that the energy stocks under Biden were one of the best, actually, sorry, not one of the best, the best performing sector under Biden. So for 4 years, energy stocks were the massive outperformer, basically from 2020 to 2024. And under Trump, solar stocks were actually the massive outperformer. So it's once again it's all backwards. So the what I'm really trying to get here is that when you're looking at trading, so many people think that the market has to run exactly the way you think it should. And really, markets do whatever they want to do, and you need to follow where the strength is. And that's the reason why we're talking so much about China and these international stocks to start the year. So, Sam, what are we looking at here on this chart?
Sorry, did I just cut out, Jason?
Yeah, you fell out. I don't know what happened.
So I was talking about at the beginning of the show. It's freezing cold here. We've just gotten a huge winter storm, so forgive me for that. I think they just cut out our Wi-Fi, but I'm on the hotspot now. So we should be good going forward. But yeah, no, this is the gold bug's favorite chart right here is gold is about to break out of a multi-year basing pattern relative to the S&P 500. And that is just so ironic to me because people just love to talk about the cash flows of these companies, but really at the end of the day, shiny rocks are just as good and right now they look a lot better than these companies.
Yeah, no, I agree. And so the S&P 500 as we're continuing to move higher here again or the gold moving higher against the S&P 500 is very significant. This is something we haven't seen in a very long time. Looking at that massive trend that kind of started in 2000, like you said, Sam, this started all the way back then, and gold has still continued to be the outperformer. Now, the momentum's on our side. And when we see gold outperforming stocks, that's usually the time where commodities start to really cycle and continue to move higher. So I think that we're going to continue to see that. And so, this is a time where you want to be in gold, you want to be in the mining sector, but you just want to be in things that are going to outperform the S&P 500. And right now, I don't think technology is the thing doing it. I think it's these other areas.
And another thing on this note, it's not just a little bit of outperformance that we're talking about. When these commodities are trending higher, they trend so powerfully. And it's a dramatic outperformance for not 1 year, 2 years, 3 years. We're talking about a decade to 2 decades. Historically, these cycles are crazy. And another thing we haven't seen move recently is crude oil futures. You saw a massive move off the 2020 lows when crude oil went negative. You saw a lot of energy stocks rally 1,000%. One of the coal stocks, Alpha Medical Resources, that's ticker AMR, rallied something like 20,000% off the 2020 low, and it was the best performing stock for all of that post-COVID bull market. So when crude oil and the energy complex gets in gear, you really want to be involved because boy, do these things trend.
Yeah, I agree, Sam. And so when we're looking at the crude oil here, this is the thing that I think people need to really pay attention to here because we've already seen gold move, and then we'll see copper move, and then we're going to see oil move. So once oil really starts to move, that's when this commodity cycle is really kicking off in those other areas. And this is the thing about it when we're all talking about international stocks, I want people to remember one thing. I'm not saying that companies in the United States can't be the outperformers. There is going to be those areas. Energy will probably become an outperformer if oil starts to move up. The copper miners will be an outperformer if oil starts to move up. But once again, this is the important thing. Right now, the S&P 500 is over 50% technology. So if you weigh in the XLY, which is mainly just technology, which is consumer discretionary, communications, company like Google, Facebook, this is another huge part of the S&P 500, and then technology, which is Microsoft, Apple, and Nvidia. These are huge companies in the S&P 500 right now, which are taking up over 50% of the S&P 500. The areas that are taking up, 2% or 3% of the S&P 500, these are materials. These are areas like utilities are also very small in there, but the things that we'd see going up in an inflationary cycle, like energy, financials are becoming a bigger part again. But those areas like energy are such a small part of the S&P 500 that think of 2022. We were just talking about that earlier. Energy did very well that year. However, the S&P 500 did not. Why? Because the S&P 500 is such a small part of that index now. Or sorry, the energy is such a small part of the S&P 500 now. It's very hard to make that continue to go higher in that scenario. So once again, looking outside of the United States or finding those smaller sectors that are going to have relative strength, that's what you want to do and focus your attention on going forward.
For sure. And on the note of utilities, I believe, correct me if I'm wrong, but utilities were the best performing sector from that period from the post dot-com bubble to the Great Financial Crisis. So that like 2000 to 2007 timeframe. And you've seen some pretty dramatic moves from a lot of these utility stocks recently. Like Constellation Energy and GE Vernova are two of the bigger ones, but uh, I call them AI utilities, but really there are secular tailwinds there for these utility stocks with all of these AI data centers we're building around the United States and the world. So I think that's a really interesting place inside of the energy trade.
Yes, no, that's a great point and something for you guys to write down because that opens up a bunch of areas like natural gas, uranium. It's pretty endless. Utilities are even going to be part of that situation. So a lot of things to look at inside of there.
For sure. We're not just talking about ExxonMobil and Chevron. Those
Hmm.
companies are kind of boring. Here we're talking about copper futures. You know, we've talked about
Also
gold.
part of the AI trade.
Yeah, for sure. A big part of it, really. It's one of the largest input costs in semiconductors and a lot of these other high-tech devices. But really, it comes down to our intermarket analysis, and that gold tends to ring the dinner bell. And like I've said, gold broke out on March 4th, 2024. We are approaching that 1 year anniversary. That comes in about 15 days now. About 10 to 14 months is what you found in your back tests, Jason, is how long it takes for the rest of the commodities complex to catch up to gold. So it's about to be 12 months. Has it been long enough? Is copper ready to break out to new all-time highs?
I think so. And I think copper already kind of gave us that signal that it's following. If you go all the way back to last year, that was a huge move. I think it was like 50% very quickly in copper. So copper made a big move last year, tapped all-time highs, and then fell off right back down. It had a big drawdown and then it went sideways for a little while. Now it's starting to move again. And what I see with a lot of commodities, and being that I've been trading commodities for such a long time, this is just an observation. I see a lot of breakouts happen like that. You'll see a huge move, it'll tap a new all-time high or a breakout zone, and then it'll go back in the box. And then the second time it starts to hit that zone, that's when the real trade starts to happen, the real trend starts to happen. So looking at that, I do think that this is a situation that this thing could start to move higher here, and just not look back. So I do think we're ready for this move to happen. To answer your question, we do have plenty of time. I just think now it's hey, is the dollar going to continue to come down here? And I think the answer is yes.
Is that the first intermarket thing you're looking at? Is the US dollar when you're analyzing the copper market, or is it something like China? You know, China's a very large consumer of refined copper. I think it's
Go back
over
to slide
50%.
slide one, Sam. We'll go back to slide one. It's all one trade.
Yep.
So, like you just said, like you're saying China, all these things, it's well said and it's perfect because that's all the trade. So when you're looking at everything, putting it all together, going, okay, what is the FXI doing? What is the K-Web doing? You could look at individual Chinese stocks if you want to go that far. I don't personally, but going into China and just saying, hey, what's their futures doing is really what I do. And go, okay, well, these are in an uptrend, these are moving. Now I want to see what's going on internationally. And most importantly, out of all of those, I want to see what's going on with the dollar. Because if I know what's going on with the dollar, I can tell that money's going to start flowing into these other areas. When China was ripping higher, that was when the dollar was in the box. The dollar started to break out of the box, and then China came under some pressure. So did copper. So now that both of these things are moving higher, copper made a 100-day high, now a 150-day high. I think copper is going to really head higher. And the copper miners are finally starting to bottom. That's exciting. So there's a lot of really good things going on here in the market.
For sure. And here is some more analysis on the copper gold relationship. Historically, copper relative to gold has looked exactly like the 10-year yield. But recently it has diverged, particularly around late 2021, early 2022, when the market was really putting in its top. I'm speaking about the S&P 500 as the market. So one of these has to be wrong. Is it the 10-year yield that needs to come down, or is copper gold going to catch up?
Yes, and when I, kicked JC off of this call because I said I want Sam instead of JC, I'm just kidding. But I knew you wanted to be here though. So when Sam wanted to be on the call, I was excited to bring this chart back up because Sam really likes this chart. And I think it's really important. If you're looking at copper, what Sam analysis has done, and so is mine, is that you see gold move and then copper usually follows it. And part of that story lately has been the copper to gold ratio and the 10-year yield. A lot of people keep going, well, yields have to go lower because of the copper to gold ratio. This environment is different than people have seen in many years. Even looking as far back as the time we're talking about, go back to the 2000s. You can see that the spread between there is a lot wider in the copper to gold ratio to the 10-year yield. And the reason is when we're in a more inflationary environment, that's going to be the relationship. The relationship is going to shift a bit. Right now, we're in a reflationary style environment, but that also doesn't mean these jaws can't close up a bit. Most of the time, it still catches up to this. So I think by the end of the inflationary cycle, which isn't anytime soon, we're going to see this ratio catch up to each other, which means copper's got to go a lot higher and copper's got to be the outperformer. I do think copper will start to be the outperformer sometime pretty soon.
And just to play devil's advocate, 10-year yields and the US dollar, if you overlay those two, they've danced together for years now at this point. They've been exactly the same. Like if you took the y-axis off of these charts and overlaid them together, you would not be able to tell the difference. They are twins. So, in that environment, if we're betting on a weaker dollar, shouldn't we be betting on weaker 10-year yields? Why does the copper gold ratio need to catch up? Why can't it be the other way around?
So it could be two things. So, sure, yields could go lower here. That is always possible. However, the environment, it goes back to what we were talking about earlier. We're looking at the environment. Are we heading into a a recessionary environment? No. Are we heading into a deflationary, disinflationary environment? That would be surprising to me. And so if we were heading into one or the other, I would say, yes, I'm completely wrong. This yields are going to drop here very hard. Right now, my thoughts on yields is that they're going to go sideways at most, and possibly higher. Now, nobody wants to hear yields can go higher, but they can in an inflationary environment. Now, looking at the dollar, if you go back to 2000, and that's the environment we keep going back to because it's different than what everybody's traded. Think of 2020. Nobody wanted to say environment's different. I have to do this differently back then. People just want to say inflation is transitory. This is short lived. Keep buying technology stocks. And really, the place you wanted to be and where the outperformance was for a few years was in the commodity space. Getting back to 23, 24, yes, it shifted back to technology again, but that's how it goes. It's always going through shifts, but the cycle for the commodities and inflation is still intact. So the commodity super cycle is still intact. So because of that, I would say this is most likely going to be a big difference in what people have been trading for many years. A cycle where the dollar is falling and yields are high. That's also it's happened plenty in history, but it just hasn't happened lately. So like that's the thing that everybody's kind of getting stuck on is like these things have happened in history, but are they going to happen today? I don't think so because they haven't happened lately. That's what a lot of people feel like. But as we know, because we're both market historians, things always change and things shift. It's kind of the same as looking at oil and the dollar. Those have to keep going up together. Well, why do they have to keep going up together? They don't. So once again, it's a things are going to continue to shift. And as we see these shifts, and that's kind of a normal environment. If you're thinking of high inflation, most of the time the dollar does get beat up in a high inflationary environment. And that makes perfect sense as currency continues to get devalued. So if we're looking at more of a higher inflation environment, an environment where things like copper are outperforming, which is more of a global growth style environment, that's going to be a scenario where yields will probably stay elevated, the dollar will continue to fall, and then we're making a lot of money on copper.
For sure. A lot of people, a lot of investors specifically, suffer from recency bias. You know, a lot of investors have been accustomed to falling yields, and that has been good for technology stocks. They haven't been in one of these inflationary commodity super cycles where yields continue to climb higher and commodities do the same. And that's, I think, the environment we're in. And this speaks to that. Commodities are breaking out of huge, like, this is almost a 5 decade long base in coffee futures. And coffee broke out, it was about a month ago, and it has just gone straight up. It's screaming higher towards that first Fibonacci extension level around 525. You're not very close to that yet. You know, there's still plenty of upside here in the coffee futures. But you saw Cocoa do this exact same thing back in 2023, 2024. Cocoa resolved a nearly 50-year base and screamed higher. And people that don't look at as many charts as we do, Jason, were kind of confused, and they were asking us, what is going on with Cocoa? And you could give some fundamental reason as to why the price of cocoa should have done what it did. But really, it comes down to um, technical analysis and these big bases that we talk about all the time. And I learned in technical analysis kindergarten, the bigger the base, the higher in space. And boy, has that lesson been good to me.
Yes, the bigger the base, the higher the space, the bigger the top, the bigger the drop. Very basic lessons in technical analysis. And this is also looking at this chart. It's one Sam has written about a few times. Sam has talked about. I also asked Sam today. I said, "So you don't make fun of me today because I didn't grab the as long term of a chart as I want to. Can you send me this chart, Sam?" So Sam was nice enough to put this in the deck today. It's a beautiful chart, and I think it really speaks to the commodity cycle and breaking out to these new highs, and those highs carving out brand new ranges that we haven't seen before. And as commodity traders, the nice thing about it is when you're commodities trader, you're looking at and you're drinking coffee in the morning, but also you're making coffee on your screen. You're not that upset about prices raising. Inflationary pressures can suck for a household, but if you're a commodities trader, you're making money on one end and you're losing money on another, but you're probably making a lot more money trading the coffee contract, which is has a value of $130,000. So you're probably making more money there than losing a few bucks on your coffee in the morning.
For sure. And that's something that we take for granted, Jason, I think, is that, recessions are a choice for a lot of people. And so are inflationary pressures. Like, not everyone can buy um, RBOB futures to hedge their gasoline expense during the summer.
Yeah.
It's a real blessing we have to be able to do that. So don't take that for granted, but at the same time, take advantage of it. These moves are very, very
And
lucrative.
not futures. If you got gasoline prices rising, there's a UGA ETF, so you can trade that. Sam and I have highlighted other ETFs, ETF products that you can trade to make money from these cycles. So there's lots of ways to do it. Top to
But
what's
what
next.
about
We
when
only
they
got a
take
few
away the
minutes, Sam.
cocoa ETF right when it's breaking out?
That's what they
It's
do.
same
That's
for
what they do.
coal, coffee. They don't
Yep.
have products for this,
Yes, and if you guys check out, if you go through here too, you'll see Sam and I did one of these lives recently. You can see where we kind of talk about all that stuff. But let's
for
hop to
sure.
what's next, Sam. We only got a few minutes.
For
Oh,
sure.
that's it. Just kidding. So, all right, guys. So, thank you guys so much for joining us today. We really appreciate everything you guys bring to the party. Thanks for bringing some questions. I love that somebody said literally hedging in real life. Um, you know,
Wavy
the,
McFly chiming in saying, I need my
yeah,
own show. I
Gatling
agree, Wavy.
gauntlets, back to back commodity charts. Make it happen, all star charts. That's true, man. And Sam is so valuable because, somebody said the other day, it was like, wow, he has a lot of knowledge for his age. It was like, yeah, Sam used to come on my channel when he was younger, and I would be like, I didn't know exactly who he was. And I would be like, dude, you're going to be richer than everybody I know in a few years because he just had a ridiculous amount of knowledge. So we love you guys reaching out to us, and yes, we are hedging in real life. And that's the truth of the futures markets is it was created for hedging, but also stocks hedge your portfolio, meaning in inflationary times, having your money in cash is probably a bad idea. Having your money in stocks, your extra money that you can have in some form of an asset, that's going to make you more money or a house or real estate or something. So these are the things you want to do, and you can learn all about that and how to trade gold following the gold rush.
For sure. We actually have a pretty steep discount going on right now. Usually it's 12.99 for a year of Gold Rush. We're giving that away for 5.99 right now. And it could pay for itself with one trade. We were talking about these junior miners earlier, and we've outlined several of them in the last few weeks. And boy, have those trades been off to a good start. So if you're interested in what we're doing here, don't hesitate to join the Gold Rush. And if you decide that we suck and we provide no value, we'll give you your money back, no questions asked. We have a 30-day risk-free offer. All you have to do is contact us at info@allstarcharts.com or give Mary a call at 323-421-7910,
If
and
Sam
she'll
does
take
not
care of you.
start the Gatling gauntlet, you can have your money back.
I love it, Jason.
Don't quote me on that.
Well, let's leave it here for the day. This was a lot of fun. I think we covered a lot of ground, laid out some good trade ideas, with silver particularly and copper also shaping up really nicely. We should come on here and talk about the grains sometime, Jason. On Commodities Weekly, our Friday note of the gold rush, we've been talking about the grains, specifically, we've been talking about soybeans and corn popping off. And I just tweeted out a chart of corn printing fresh 52-week highs. I think that one's just getting started.
Yeah, let's do that. And if you guys want to see that, feel free to write in. We love to hear feedback from you guys, just to understand what you guys want to see, because we could talk commodities all day, every day. We just don't know if everybody would listen. So the more we hear that you guys want to see it, you guys are listening, you guys are excited about it. We'll keep covering it because we really love talking about commodities and chatting markets with all of you guys.
Yeah, we do. Let's do this again soon. Everybody, thank you for being here. This was a great time, and we will catch you later.